today's webinar. Our first speaker to introduce Matthew Dundon. Matthew Dundon founded Dundon Advisors in 2016. Mr. Dundon has been a global credit, litigation, and distress investment leader for more than 13 years. Matthew is the research head at the Miller Roberts Securities Group and a portfolio manager at Pine River Capital, as well as Advent Capital. He was from 2010 to 2016. Throughout his career, Matthew Dundon has been the legal counsel on dozens of litigation-intensive investments and trading opportunities. Also participating, Mr. Darren Azman. Mr. Azman is a member of McDermott's management committee and is a partner of the Business Restructuring Group. Darren's practice and professional career is focused on corporate restructuring, credit rights, and distressed acquisitions. Darren's clients include private equity sponsors, troubled companies, official creditors committees, financial and strategic purchasers of distressed assets, and others in connection with in-court and out-of-court restructurings. Last but not least, Mr. Joe Evans. Joe's professional focus is specifically on cryptocurrency and fintech companies. Recently, Mr. Evans was recognized as a, quote, trailblazer for his work in the crypto industry by the American Lawyer. Since 2013, Mr. Evans has been involved in all things crypto and blockchain, including defending government investigations, pursuing cutting-edge crypto litigation, representing creditors committees and liquidation trusts in high-profile crypto restructuring cases, obtaining money transmitter and other state licenses, and advising on initial coin offerings. Joe leads a team of crypto lawyers who are devoted exclusively to working on cryptocurrency and blockchain matters. So, Darren, Matthew, and Joe, thank you so much for being with us today. First question is for Joe. Help us out. Educate us. What's crypto? What's blockchain? So what? Who cares?
Yeah, no, good question. And hi everybody. Thanks for having us all. And I think the thing that is the barrier to entry with understanding crypto is just getting some of the key definitions down. It's really not as complicated as it might seem. There's a lot of words that are floating around, and some of them really mean the same thing. And so I'm just going to go through a little bit of the terminology and explain what they are and why we care. So crypto, right? What is it? There's a bunch of different terms you probably heard. Virtual currency, digital assets, cryptocurrency. For purposes of this presentation, we're just going to call it all crypto. It's all basically the same thing. And it's a digital asset, meaning that it's an asset that exists on the internet, not issued by a bank, not backed by a government. It's issued on the internet, and it has value because other people are willing to pay for it for value. And you can transmit it all across the world without an intermediary. You can if David was across the world, I could send my crypto right to him right away. And that's what cryptocurrency is. It's valuable only because people will pay for it. And you could buy things with crypto, you could pay for services with crypto, but the primary use still, about over 90% of the transactions in crypto are for speculation, hoping that the price of crypto will increase in value. And so there's not just one type of crypto. You probably heard of Bitcoin or Ether and other different types of cryptocurrencies. There's thousands of them. Now let's talk about the first one, Bitcoin. Bitcoin's the biggest show in town. It has approximately 500 billion in market cap as of today. And Bitcoin is the most popular by far. It's worth about $23,000 as of this morning. And it accounts for most of the transactions in crypto in the world. And Bitcoin is on what's called a Bitcoin blockchain. That's different than other cryptocurrencies that we'll talk about in a second. And so what is a blockchain, right? A blockchain is the underlying contract that makes this all work. It's a contract that allows me to transmit my crypto to David. And what it also does, and it's very important for asset tracing when it comes to, is it records every single transaction that has ever existed. So from my first purchase of crypto back in 2013 until crypto that was bought yesterday, you can go online to what's called a blockchain explorer and see every single transaction in the world. It won't have my name attributed to it, but it'll have the numbers that are attributed to my wallet, and the transaction will be there. And so it's not like a bank ledger, for example, where every different bank has their own ledger. This is one ledger that covers all the Bitcoin transactions that ever existed in the world. But let's talk about the word blockchain, right? The reason why it's called blockchain is because when a transaction is requested to be transmitted, so when I want to send my Bitcoin to David, my transaction and everybody else's transaction that wants to occur on that same moment, they all get tallied up. They get tallied up. And when enough transactions are in place, they all get executed at one time. It's a block. And the blocks are all tied together. So if you look at the blockchain, you'll see a block of transactions, a block of transactions, a block of transactions. And that's why it's called blockchain, because all the blocks that ever existed are in a chain. So Bitcoin was around for about 2 or 3 years. And then there was another token, another cryptocurrency that's very important called Ethereum. And like Bitcoin has a blockchain, Ethereum has a blockchain too. And it's very similar. The difference with Ethereum from blockchain is Ethereum gave the ability to create other Ethereum tokens on the Ethereum blockchain. And those are called ERC20 compliant tokens. The reason why that's important is because it made it very user-friendly for companies or what we call project teams to issue their own new tokens. So when you see all these crazy tokens, Dogecoin, and pictures of sheep with a coin attached to it, those are all Ethereum tokens. Those are ERC20 compliant tokens. And the main reason why it's important for our purposes is it became extraordinarily easy to get to market with a new cryptocurrency. And you didn't have to create your own blockchain and spend a year with developers to do it. You didn't have to get a whole bunch of funding to do it. You could start selling your crypto into the market right now, a couple days to issue your token, depending on how good you are with it. But it's really like I call it like a Wix for websites. Very easy to issue your new token, and it's all about marketing. So what it did is it created a lot of interest and a lot of value in companies that really weren't prepared for that kind of value and interest. And we're seeing the aftermath of a lot of these things happening now. And this was really prevalent in 2017 and 2018. But to be sure, people are still launching new tokens every single day. We're getting calls every single day about new tokens, and it's a way to raise money without giving away equity. So you're not getting shares in a business, you're getting a token, and you're betting that that token will increase in value. So companies don't give up their equity when they issue these tokens. There's a couple other items that are interesting to understand and really important as of recently. There's something called a stable coin. And a stable coin, the purpose of a stable coin is to be tethered to the US dollar or another fiat currency, a government-backed currency. And those are supposed to be each worth $1. And they're very important because when we see commercial transactions, cross-border commercial transactions, loans between sophisticated parties in crypto, they're often in stable coin because you don't have to worry about the price fluctuation. It's supposed to be $1. What we've seen recently, especially with a company called Terra Luna, is doesn't always work. So they're tethered to $1 until they're not. And so we saw one token, for example, drop from worth $1 to worth only a couple cents. And so there's a lot of issues concerning stable coins and which are actually asset backed and which are not. NFTs is another thing that people have heard about. NFTs are those crazy pictures of like gorillas and sharks and things that people are trading. There's something called the Bored Ape Yacht Club, which everyone needs to know if they know anything about crypto. That they're pictures of apes that for a while were trading at a minimum of 500K each. They're at 150K each now. But we're seeing real investors getting involved in these NFTs, which are kind of kid-like pictures, but they're being traded quite frequently.
So go ahead, last comment, but this is all really helpful.
Sure. Last comment is this. The thing that's important to recognize is the whole purpose was wide open world. I can trade all over the world, easy peer-to-peer. What it has created is a cottage industry of middlemen. And so the biggest players in the industry are those that are connecting me and David and taking their feed. So while the ethos, the purpose was to eliminate financial institutions, eliminate middlemen, really what we're seeing is a ton of middlemen. Mm-hmm. And some of the biggest bankruptcy cases that have happened, some of the biggest companies that have failed are those middlemen in between because they're holding the assets of everybody else. And so it's not exactly peer-to-peer, it's usually peer-to-peer with somebody in the middle, and that person in the middle has failed on many occasions.
That's great. And before we widen it and bring in Matt and Darren, two quick questions. So Bitcoin, just for clarity, does not have this ERTC compliant channel. Okay.
That's right. Yeah, it's called ERC20, but yeah, that's right.
Great.
Yeah.
Thank you. And that, yeah, we'll come back to that if perhaps. But and second question, so these issuance, are they a security?
That's a $500 million question.
We can come back to it, but I just
you don't have to. I'll give you the brief summary. The SEC has changed its position almost every 2 years on which ones are securities.
Okay.
They issued their most robust guidance in 2019, where they gave us 62 factors to consider when determining whether or not it is a security. Not one is weighted higher than the others. The SEC has basically taken the position that they can choose which ones they deem to be a security, and it gave the SEC a lot of latitude to choose enforcement actions, but it also gave token issuers a lot of latitude in making really unique arguments about why their token is not a security. And so the answer is, if I knew, I wouldn't be doing legal work all day long. I'd be on a boat somewhere probably. But
well, if there's a silver lining, and Darren and Matt will get you in here right now. If there's a silver lining to that reality, Joe, is the three of you have job security.
Yeah, until we don't, right? Until the next cycle.
Sure. So Joe, thank you. We'll circle back here shortly. But Darren and Matt, tell us just high level. Tell us about yourselves and how you got into this specialization. My sense is you three of you have slightly different areas of specialization, but let's explore that. Darren or Matt, would you mind going first?
Happy to. So our firm, Dundon Advisors, or my firm, is a 40-person asset management and restructuring advisory firm based in New York with folks with an office in West Palm Beach and in Shanghai, people in New York and all around the country and in China. We have a variety of businesses, but kind of unconventional, distressed, and high yielding situations are a common theme that run through most of what the folks on my team do. And we had a interest in cryptocurrency all along and dabbled in it here and there. We actually kind of came into it in a more robust fashion along with Darren about 2 years ago, when we were both chosen to advise the creditors committee in the largest up to that point, and the largest up to a couple months ago, Chapter 11 case involving crypto, that of an entity called Cred Inc. And we're still involved in that, advising the liquidating trustees. And we've gone on to do a variety of other things in this space, broker loans backed by crypto. People borrow fiat against crypto very heavily, and we've structured and marketed very large loans backed by crypto assets, and are advising a number of creditors and equity holders and token holders in a variety of the current situations that are going on now, Voyager, Celsius, and several others that are regarded as tenuous but haven't yet filed for bankruptcy. Our approach in everything we do is to look for strategies of value. Crypto bankruptcies are a hybrid of novel factors relating to the fact that the primary assets and liabilities are associated with the crypto business, and let's call it ordinary factors around clawbacks, frauds, calculation of liabilities and so forth. So it draws on. It works best with people who are solid, utility players in distress who have been able to build up some specialized capacity.
Thank you. That's great. Very helpful. And Darren, how about yourself? How did your career evolve? Your specialization has taken place.
Yeah. Hey, everyone. Thanks for having us, and nice to meet all of you. My first foray into crypto was around 2018. Crypto, at least from a law firm perspective, was still fairly in its infancy, but we had brought over a group of lawyers that were really financial institution guys and girls and they had developed an expertise in crypto. I mean, it wasn't very old. It was maybe a year or a year and a half old, but they were doing a lot of the ICOs, or initial coin offerings, that you heard Joe talking about before. Companies going out, instead of raising equity capital, raising token capital by just, minting tokens. And I saw that as an opportunity to get in sort of on the ground floor. There was no distressed element, but with all new things like that, where there's a lot of hype, you sometimes can see 5-10 years down the road, mortgage-backed securities, right? There's a lot of great analogies there.
Mhm.
And I suspected that at some point there might be serious distress. And so I approached that group and said, hey, I'd love to get involved. And, within a couple of weeks, I was working on initial coin offerings for these companies. And, we were, everyone was learning at the time, right? These were not form documents that had been around for 30 years, like lawyers are typically used to working with. We had a really great group of, securities lawyers that were working on it. So we had great analogies and great precedent. And so that was, probably a year and a half. Developed a lot of relationships in the crypto industry because of that. Several clients still to this day who have had successful token launches and are continuing operating thriving companies. And then, like Matt said, our first, opportunity in the distress space was the first, crypto bankruptcy filing ever. And it wasn't only the largest at the time; it was really the only U.S. Chapter 11 case, and that was the case of Cred Inc., which is, a whole case study in and of itself. There's a couple folks on the call that are not on the panel that were involved in that case. I see Pablo Bonjour, but that was, a case that was ripe with everything you can imagine in, a novel. You have fraud, you have, people finding out that the former chief capital officer of Cred was an escaped convict from a UK prison. You have a guy that's got $250,000 of cash he stole from the company in the trunk of his car that we found out during a deposition. It really represented all the things that are wrong with crypto. And so we were retained, as Matt said, to act as lead counsel to the creditors committee. That engagement's ongoing now. It's been about 2 years, and we just filed our second major lawsuit suing a crypto exchange for close to $800 million for their participation in what we view as significant wrongdoing against customers in that case, who are out close to $500 million. And then between Cred and now, up until about a month ago, Joe is really at the forefront of, the non-restructuring work. But as a result of his crypto expertise, he's been brought in and has been doing a lot of the crypto litigation that we've had going on in bankruptcy cases. But his practice has also brought on clients that have touched on insolvency issues. And that includes clients that have had, major data breaches. And when I say data breaches at a crypto company, I'm talking about major thefts, hundreds of millions of dollars of crypto stolen. And we're brought in to advise on, restructurings, asset tracing, which we'll hopefully be able to get to in a little bit to talk about how that actually works. And then more recently, the most significant case is Voyager. And so just, I guess it was last week, we were retained as lead counsel to the creditors committee in Voyager. And then in Celsius, ironically, we're representing the Cred Inc. Trust, the first case I just mentioned, which has a significant claim against Celsius. And so, what you find in this business is that everybody's interrelated, and we all talk about how the bankruptcy community is small. The crypto world is even smaller. And so that's how I got into it.
That's great, Darren. Thank you for that. And just for those participating, I mean, there's a lot we could talk about, right? So I'm going to zoom out for a second. I mean, we can't boil the ocean, right? Web 3.0 and blockchain and NFTs, and then how much utility and value is actually created, et cetera. We can't address all of that in 50 minutes. So the focus of today's call as a part of the Turnaround Management Association really is on the bankruptcy, the turnaround, the restructuring, the legal precedent, some of those issues. So we are going to really focus there. But if there's an opportunity to address some of the wider issues, we perhaps might. To the group, to the three of you, what is a good story you could tell of a case you worked on that you think best sort of illuminates or explains the sort of turnaround restructuring work that's taking place in the industry? And related to that, there's a little bit of discussion around the risks, like the risks that are just inherent in this category. So could we get a story of something that you worked on that you could share with those folks on the webinar?
Darren, you want to start with the war story? I'll pick up.
I was going to say, why don't you start? I mean, Joe, I mean,
Yeah,
James Alexander, why don't you
Sure.
pick one?
Yeah, so I'll start with the war story from Cred. In Cred, we had a chief capital officer who had previously taken money from the company. He claimed that it was for a separate business. We didn't think it was, but there was a freeze order in place, and the California State Court, before we got involved, there was a freeze order in place, and something that I'm not sure anybody really thought about at that time, and that we were nervous. It kept me up at night. But normally, when you freeze an account, you serve that freeze order on a bank, and that bank makes sure that that money doesn't move. When a freeze order is on just somebody's digital wallet, you're just hoping that they stay honest and don't move the money. And so we were looking at the wallet every single day, looking at the wallet, money's still there. We woke up one morning, we checked the wallet, and all the money was gone. And so we worked all overnight. We got an expert report done in about 6 hours, and we filed an emergency motion in court to return all the stolen money to the estate. And the judge heard us right away, qualified the expert in a second. We proved to him that the money was stolen. Here it was, here it's not. Remember, we only are able to track this because all the transactions are public. And so we could see it in real time. You don't have to wait till you subpoena a bank and find out 6 months later that the money was taken. We found it that morning. The judge asked me, how long would it take you to transfer the crypto back if it was in your wallet? And I said, Judge, it'll take me 30 seconds. He said, well, I'll give him 30 minutes. He has 30 minutes after this hearing to give you all the money back. Yeah, that was the order. So we got on the phone, me and Darren and others, we got on the recorded Zoom call with him, and he said it was every excuse you could think of. He's suffering the after effects of COVID. He's not technically sound. His laptop, his hard wallets are in a basement in Las Vegas, and everything you could think of. But at about midnight on a Friday night, he transferred the crypto back. I mean, we literally had to tell him which buttons to press on his machine to transfer it back to us, and we returned millions of dollars. At the time, I think it was about 9 million and more now. But we got it back. And so, following that theft, we've done a whole host of investigations with him. We tried to throw him in jail, hold him in contempt. That almost worked. We're deposing his wife actually at the end of the month. But that's sort of the crazy thing that happens. Kind of crazy thing that happens in crypto that may not happen in other situations. And so what everyone should really be aware of is a freeze order is just a promise, right? Unless there's a third party holding the assets, you got to keep an eye on it, because if he moves it, and it's gone. And so we were able to get most of it back.
Yeah, I'll just give an add-on to the story. So we had subsequent depositions of this gentleman, Mr. Alexander, just trying to find. We got most of it back, was 90%, but there was still some missing. And we continue to take depositions because there was lots of other wrongdoing at the company that we're trying to get information on. And probably about 2 hours into one of the subsequent depositions, he said he needed a medical break. We said, okay. He left and he came back. Actually, his counsel came back on and says, Mr. Alexander's filed for personal bankruptcy. This deposition is terminated. And so he filed for personal bankruptcy in the middle of the deposition in California, which is where he lives. Within about a week, I filed a motion to transfer his personal bankruptcy case from California to Delaware, arguing that it was related to the Cred corporate bankruptcy case, and something you don't do, right? You don't get personal bankruptcy cases transferred to other jurisdictions. It's always where the individual is located. And the judge agreed. So the judge dragged him into Delaware bankruptcy court. That's where his case is pending now. We worked with the United States trustee to oppose the discharge, arguing that he committed fraud. And we won on that. And so, he'll emerge from bankruptcy, and we will be able to sue this individual for the rest of his life for every dollar that he ever makes. And we intend to do that.
Matt, anything to add from your seat in your career? How example of a war story that is relevant to the industry or the unique risks of the industry?
So one of the things that we face in insolvency is a sense of what is the prudent standard for holding speculative assets. And the universe of crypto bankruptcies is dominated by people who are true believers in the blockchain and in cryptocurrency blockchain applications. including but not limited to cryptocurrency, as kind of not just transformative of the economy, but sort of transformative of society. And so one thing that they are very, very characteristic of them is they are permabulls about the value of Bitcoin and Ether. And it requires their harsh opponents of selling Bitcoin and Ether for dollars in the course of a bankruptcy, which puts an estate and a liquidating trust kind of in the position of speculation. Now, the beneficiaries take the opposite position, which is selling crypto to generate dollars as speculation. And what you should do is respect the underlying enthusiasm and bullishness of the creditor community, and not attempt to remove crypto-based volatility from the equation. And that intensity was very easy when Bitcoin was trading at 60,000, but it stayed pretty intent all the way down to the lows of, that we experienced over the past 6 or 8 weeks of, briefly touching into the 16,000 on Bitcoin and comparable levels on Ether. And, things are back up again. Bitcoin's trading close to $24,000 as we speak. But it creates some very interesting issues legally. It also creates some interesting issues tactically. We before our experience with Alexander, maybe at a similar time, we had to come in and essentially stop a debtor from making a what was perceived by our clients to be a fire sale, and take meaningful risk from the perspective of a creditor committee, which is not usually supposed to be an economic principle, and cut a Bitcoin sale from, in amount by 90%, basically from a large fundamental change in the asset base of the company to simply liquidating the amount of Bitcoin that was on. And I think that is something that anybody who's going to get into this space on behalf of lenders, account holders, token holders, equity investors in these companies is going to find a near unanimity that they're going to have to address. And to the extent that the client is always right, you're going to have to do this. And where it's going to get very interesting. So in cred, one of the things we did is when we transitioned from a Chapter 11 case proper to a liquidating trust, instead of hiring a professional fiduciary to be liquidating trustee, and which is the common order when your Chapter 11 plan creates a liquidating litigating trust, it is customary that the trustee or trustees be drawn from a relatively small pool of professional trustees, people who do trusteeship full-time or part-time. And I'm one of the people who does that and holds 6 or 8 trusteeships at any given time, and there are people who hold 20 or 30 at any given time. Instead, we elected to have 3 of the account holders who'd been on the creditor committee become a board of trustees. And so that meant that the fiduciary role was continuing to be exercised by people with this basic bullish sentiment, as opposed to professional fiduciaries who might feel very strongly inclined to liquidate volatile cryptocurrency positions. And as we look at the Voyager and Celsius and other recently filed cases, that's certainly one of the things that's going to have to be borne in mind when both in creditors giving guidance and debtors making decisions about what they're doing, and then also how and to what post-effective date structures are being chosen, that if professional fiduciaries are being brought in, what advice are they going to be taking, and what comfort are they going to require to not just direct the liquidation of all the crypto on the first day that the keys are in their hands.
That's really interesting. Thank you, Matt. And just a comment to the folks participating: ask questions in the chat box. My colleague, our Dylan Zwick, is filtering them and will be chatting with me directly to make sure we answer as many questions as we can. We're going to come back to something you said in a minute, Matt, but question for Joe. Joe, I believe Darren mentioned this, but I want to build on and ask you the question.
Sure.
Darren mentioned this interrelatedness, or perhaps you did, this interrelatedness kind of investment between entities in the crypto world. So the question is, does this interrelatedness within the ecosystem, is it already causing any sort of snowball effect or contagion, for lack of a better word, of bankruptcies? Is that happening right now? Or
So
100%. I mean, there has been the two current bankruptcies, Voyager and Celsius, and the BDI insolvency, which has a recognition proceeding in under Chapter 15. So let's call it 3. There, a lot of it is sort of just a house of cards falling over, right? Voyager was directly, its largest asset on the balance sheet was a very large loan to 3AC. 3AC became incapable of paying back that loan because it lost a ton of money in a failed in a failed stablecoin. Not so much just in the stablecoin itself, but also in the token that was supposed to make the stablecoin stable. And we probably don't have to. Joe could probably do another 20 minutes on how Luna and that was supposed to work, but it didn't work. And so these things all happened, and then you had, as the value of crypto fell, right, then that sort of becomes a and Luna itself, interestingly, or that sponsor, they're not yet in bankruptcy. But those catastrophic losses and the drop in pricing, this is the classic Warren Buffett, when the tide comes out, you see who was swimming without a bathing suit. And right now, everybody in the space is trying to stabilize their balance sheets, and people in, let's call it, the conventional financial markets are looking, and I have calls every day from private equity firms saying, hey, is there some place I can come in and safely make a bailout investment, right? Because right now the bailout investments are coming from Sam Bankman-Fried and a couple other people who are already in the crypto business. And, who Sam Bankman-Fried is bailing out is himself, right?
Yeah,
There's
that's
no doubt about it, right?
yeah.
His bailouts are designed to try to staunch the pain that would eventually sweep him off the board as well. We have not yet seen we haven't seen Apollo, and we haven't seen Oaktree come in and say, okay, here's the crypto name that I'm going to dump a $500 million stabilizing investment into. But they and lots of smaller hedge funds and private equity firms are looking for that opportunity, but I think they haven't yet found it. And, because there's just not a confidence of where the contagion stops. And there's not a confidence really in sort of who has value yet. And maybe Coinbase might be able to raise, $2 billion from a Japanese bank or something like that. Joe probably is also as involved in me, or more involved in sort of people thinking about bailouts. Joe, any thoughts?
yeah, no, look, people are thinking about it. A lot of these companies have real value, and I think one of the things, David, to get to the heart of it is the way crypto companies and people in the industry make decisions is not the way that traditional financial institutions make decisions. You rarely see things like investment committees. You rarely see things like real diligence done on investments. You often see things as, well, everybody else is doing it, so I should do it too, right? And I go to these conferences every year.
Joe, it's touching that you think that that's not how the broader economy also works in terms of.
Well, I know it works that way too, but what I'm saying is it's a lot more acute. Things are moving very, very fast. And in many of these companies, you have people in very senior risk positions that are maybe 25 years old, 30 years old, no real experience other than, going to an MBA and making these kinds of decisions without any adults in the room, right? That happens very frequently. And so many of our clients that will come to us, some of them big names, right? You might have 2 or 3 decision makers, 10 employees, right? These aren't big organizations with protections and controls in place. Maybe there's 1 lawyer in house, maybe, sometimes none. And so one of the reasons why when one fails, many other fail too, is because if there's a big investment and a big devotion of capital into one entity, there's by a major crypto player, you're probably looking at 20 or 30 other major crypto players that do the exact same thing without the kinds of protections that you would have and the downside protections that you'd have at a more advanced and mature financial institution.
Yeah, there's 2 things I want to just flag, and we might come back to them, but these are really good points. One of them was that, self-fulfilling prophecy component of, if you're drawn to the category, you're sort of a decentralized person, right? And so maybe some of those risk procedures and committee structuring doesn't exist. It's less prevalent for that reason. And then And then to your point, Matthew, we'll see what happens with the bailouts or, acquisitions of more institutional traditional groups. That's just something to monitor, right? Is it valuation? Is it like, why aren't deals happening, right? Maybe it's because there's not real value there. Maybe it's because they can't agree on terms, right? So that'll be something for us to monitor in the weeks ahead. Any comments before we move on?
Everyone is taught, everyone who does these kind of bailout investments is taught, don't catch a falling knife. And so I think we have two factors going on in bailouts. One, you have non-crypto professional investors have limited knowledge, and especially their senior investment committee members, things like that, have limited knowledge of the space. And it's not like saying, hey, I want to bail out a pipeline operator or something like that, where everyone has had ancestral experience of that. But two, that's a negative process wise. But what's a positive process wise is that very few large crypto companies have any material secured indebtedness. And so your big problem with bailing out a typical distressed company that's on the verge of bankruptcy is all their assets are pledged to a secured lender, and you can't, any money you put in comes junior to them, and it's very hard to inject junior capital in a company that's circling the drain. These are companies that, because for the most part, the typical secured lender didn't consider them creditworthy, they may have little or no secured debt. And we certainly know that was, Celsius and Voyager tried to use that as an angle. They were out looking for secured debt bailout financing that they ultimately couldn't secure. But for people who are a little less, who are, farther up in the toilet bowl as it circles, from the drain, that's certainly a level. And so some of you guys on this call and gals who commit bailout capital and get asked to do that, take those calls, because there could be somebody who has a lot of Bitcoin and Ether, which are tangible assets that are good collateral with an appropriately conservative LTV. They are simply unencumbered. Now, you can have some concerns about, well, might it be a fraudulent transfer? The same concerns you would have about bailout financing in any context of a company with low amount of secured debt, but you still have angles to play. So I do think we'll see the opportunity. And as I said, it's not like, many institutions are actively looking for these opportunities. They just haven't quite matched up yet publicly. Now, this is one last coda to this, right? Trust is incredibly important as a financial institution that is transacting in cryptocurrency and blockchains. So if you're in trouble, what you really want is for no one to know you're in trouble. And you don't want people to know that you were in trouble. So the successful bailout deals are going to happen extraordinarily quietly. And they are not going to be accompanied by press releases, right? They are going to, if you're out there looking to do this deal and get these terms, and maybe a year from now when Bitcoin is trading at 40,000, maybe somebody says, hey, yeah, I want to disclose that I made a $150 million senior secured loan with some warrants to company X, and it was nice and successful, when kind of this market trauma is in the rearview mirror. But right now, if somebody came out and it became known they got a $100 million bailout loan from Apollo, that would be bad. That could start a run on the bank. People would say, if you needed that bailout, maybe you didn't get enough of a bailout, you're in real trouble.
And are we on like that's a great point, Matt, because maybe it's happening and we just don't know about it, right? None of us know about it. You guys might know about it, but you're under NDA, blah, blah, blah. But I think, are we on the topic of disclosure, and there's not a requirement to disclose investment? Is that a relevant point?
Yeah, these companies, they write their agreements with their customers in a very, like everybody does, their customer agreements are very favorable to the company. Yeah. Right. And they're private companies. They certainly don't have any SEC disclosure obligations for the most part. So, they're going to disclose what they want to disclose and what the investor wants to disclose. I would say I don't think there are a bunch of secret deals happening now. People are looking for deals, but the modality for deals in August could be when those first 2 or 3 big deals go down in the 9 figures. We're not necessarily all going to hear about it. That's what I'm saying.
That's really interesting, and we'll kind of keep an eye on that collectively, Joe, because now we're back to the values of the category, right? And if Web 3.0 is all about transparency and borderless, blah, blah, blah. Well, isn't that hypocritical to not disclose investment from a third party?
Yeah,
Right,
yeah,
so
it is.
who's monitor.
Yeah, no, it is. And so many of our clients and many people in the industry are very, very open with most things. Getting a bailout, maybe not, but they're very open with most things. So we have some clients that are decentralized, meaning all of the decisions are made by the community, by the stakeholders. They literally have a Discord channel where they say, hey, we want to do this. Does everybody agree? And if the majority doesn't agree, it doesn't happen, right? And you're talking thousands of, some of them kids making decisions, thumbs up and thumbs down on Discord, making real company-wide decisions. So yes, it is against the ethos to not disclose, but it doesn't surprise me that they don't disclose that. Many of the exchanges that have been filed for bankruptcy publicly and some other failed projects are really retail focused and not heavy crypto head focused, right? Not like hardcore crypto investments. A lot of them are random people buying their first Bitcoin, right? And so it's a little bit of a different profile when it's that kind of a business. And one thing I would say about the bailouts, and one reason why some of the deals are not getting done, we've done a number of these, but basic things that regular financial institutions that would do bailouts ask for, like due diligence materials, like compliance with laws rep, like do you have all the licenses that you need in every jurisdiction? Most companies don't. And so they can't make basic reps that gets counsel comfortable with an investment. And so there are a variety of licenses and things that crypto companies may need to do depending on who you ask. And if you ask 10 different lawyers, they probably tell you 10 different things. But I think that's causing a depression of institutional normal investors getting involved because basic questions can't be answered in the way that they're comfortable with.
But what's interesting, like Voyager was publicly traded on the Toronto Stock Exchange, right? Their financial statements, you can go on SEC Edgar and look at all of their holdings, yet still here we are with them in bankruptcy because they made a $650 million loan to a company called 3 Arrows Capital that failed because of the Terra Luna collapse that Joe mentioned before. And so, that was an attempt by a company to say, hey, we're going to be different, right? We're going to have like transparency in the public accounting sense, but even that is not really true transparency because there's only so much that shows up on a balance sheet that you file with your 10K.
That's a really good point. That's a really good point. And I want to stay with you, Darren, and ask this next one. Just real quick, we're about 12 minutes left. It's a hard stop for everyone. Get your questions in if you have them. But on the topic of retail, and this is for the group, but Darren, you go first if you feel comfortable. How are customer deposits treated in a bankruptcy? Maybe that's to be determined, but just educate us on that area.
I'll speak very high level because this is an important issue that may and very likely will be litigated. It depends on how the crypto is held, right? And let me back up a step. Why do we care whether crypto is property of the bankruptcy state or not? Okay, we care, for example, if there's a secured lender that has an all-asset pledge where the company pledged all of its assets as collateral, right? That lender is taking its collateral back when it forecloses on its loan or when it defaults, whatever happens, right? Whereas if the crypto is customer property held in trust, it doesn't matter whether you pledged it or not. It's not going to work. It's the customer's property. There are other variations of facts where it matters, but there are also variations of facts where this question doesn't matter. For example, when you have a bankruptcy case and you have no secured lenders and you're just handing all the crypto, whatever it is, right? If it's, 2 billion you owe to customers and you just have $1 billion left, you're handing all the crypto back to customers, pro rata, it doesn't really matter. Now, the asterisk on that is that it matters because someone who has Bitcoin might want their Bitcoin back because Bitcoin might have gone up astronomically, whereas somebody who has Ethereum, let's say Ethereum's gone down in that period of time, they might want their Ethereum back. So it's not so simple as saying, we're just going to, liquidate it all to US dollar value and give everyone their pro rata share, right? Some people genuinely would want their crypto back because it has an economic difference. So, again, in some instances it matters, in some it doesn't. The real question is, how did the company treat the crypto, right? If you look at analogous case law, and there's no case law on this, right, in the crypto space. If you look at analogous case law on property that's held in like, a bailment relationship, a trust relationship. What matters is how the bailee held the property. Were they commingling it with their personal assets? Can you trace it, right? Imagine you're holding 2 gold bars, one is for me and one is for the company. You can identify them if they have an etching in it that says my name on one and the company's name on the other. But what happens if you melt those 2 gold bars and combine them? It is a commodity, it's fungible, it's just like cash. And that's really where most of the case law is. It's about commingling cash and you can't trace it. And so, the prevailing view, I think, is that if the crypto exchange is commingling Bitcoin and other crypto in what are called omnibus accounts, which is generally how exchanges treat crypto, it may very well be property of bankruptcy estate. But you have an additional layer of complexity with companies that are also operating what are called lending platforms, right? These are the platforms, or yield earning platforms, as many people call that. This is where you're not just transferring your crypto to the platform to hold it there, just in a wallet. Like Coinbase, for example, like with Coinbase, you're just holding a wallet there. They have other products, but that's their core product. But with lending platforms, you're effectively loaning, investing, depositing, you can call it whatever you want. You're transferring your crypto to the platform. They're guaranteeing you an interest rate or a yield on that. And how do you think they promise you a 12% yield, right? It's not magic. Yeah. They're using your crypto and they're taking it and investing in things like the 3 Hours Capital deal, $650 million that may ultimately fail. And so how could that possibly be deemed your property as a customer if they literally converted it and the terms and conditions say that that's exactly what they're going to do with it? Yeah. And so at some level, it's actually not such a complex issue, but I think that it really varies from platform to platform.
Matt, any comment on this topic?
No, I concur with what Darren said. I think that, yeah, I concur.
Okay.
Time. I don't know if we have 10 minutes for.
Yeah, no, that's great. I'll ask you this then, and get it. I'll ask for you, Matt. Then Joe and Darren get in.
Sorry. Let me add one thing. I think that we are going to see the account holder, issue litigated. And it's going to be litigated on a couple of fronts. But for now, what we had in CRED, you have to think the treatment of the accounts, commingled or not, in some cases is driven by the absence of people who were advocating for other treatments. So in CRED, we have not had robust opposition to the approach that the plan takes in CRED. But certainly in Celsius and Voyager and in other cases that are bigger and have more complex set of stakeholders, I think we are going to see this stuff get litigated extensively starting this year.
Yeah, that's great. That's really helpful. Joe, this question for you. The title of this webinar was Fact, Fiction, and Fraud. It's been a great 40 minutes, 42 minutes, whatever. We haven't dealt a lot on fiction though. So my question for you is, where's their myth or hype or untruths? Illuminate us.
Sure. Let me tell you what I think the biggest fiction or hype or untruth is. I think it has to do with stablecoin, and stablecoins are very popular, and they're known and marketed as being asset backed. And if it's truly asset backed, and some of them are, that means there's cash in the bank. And if you have your stablecoin, you can go get $1 back for every one of your stablecoins. There are hundreds and hundreds and hundreds of stablecoins in the market. Most of those are not like that. And so there is the fiction is that your stablecoin is safe because the company says it's safe. And the other thing that everyone needs to consider when evaluating stablecoin, and this is relevant for the bankruptcy context, because when a company files for bankruptcy, they often have a lot of stablecoin and different kinds of stablecoin. So which ones do you want? Which ones don't you want? There is often financial reporting by what we call project teams about the safety of their token, because they show how much money they have backing it. But when you really look into that, first of all, it's usually not cash. It's usually some form of crypto or investment. The other thing that you need to look at is, okay, there's cash there, there's assets there, but can I redeem it? Can I take my one stablecoin and return it for fiat? Often the answer is no. And so what you're doing is, okay, fine, you guys have some money, but what happens to my coin if it starts dropping below $1? And so I think the biggest fiction on the market right now is the safety of stablecoins when they're not truly asset backed and redeemable. Not all of them, but most of them are not.
Yeah, that's great. And in the short bit of time we have left, one more question for Darren, one for Matt. And whoever prefers to answer this, please do. But Darren, I'm thinking about you here. Where is there a precedent bottleneck? We've talked about lack of precedent, but where is the biggest bottleneck where we need some legal precedent to really move things forward for the industry?
I think it's the treatment of digital assets. And it's a broad statement, right? For example, Article 12 is being proposed to be added to the Uniform Commercial Code. It probably will get adopted by most states. Article 12 is being added to, it's all about digital assets. And it includes modifications to Article 9 about how do you perfect a security interest in crypto, right? A lot of crypto denominated loans are outstanding right now, and people have filed UCC financing statements. People have attempted to affect control over it as you would to perfect a security interest in cash. Nobody really knows which ones work. Wyoming and I think maybe Montana have recently adopted modifications that clarify that, but there's not really an all-encompassing it's not all-encompassing clarity in what you do. But how do you treat tokens? So for example, Celsius, all these large platforms, they have their own tokens, so it's not equity. And it's not crypto that you deposited or loaned. It's their own cryptocurrency, that gives you benefits. For example, on Celsius, if you held certain crypto, so if you held the crypto that they issued, you might get a better yield if you have enough, right? What happens to people in a bankruptcy that held that crypto that was issued by the bankrupt company? What is that? Are you an unsecured creditor just like all the other holders of crypto? Are you entitled to your pro rata share? Is it more like equity? Those are things we have no case law on whatsoever because it's a completely made up product, right? We don't even have the analogy that we have with commingling crypto that we have with commingling cash, right? There's a decent analogy there. What is a token that's issued by the company that gives you governance rights or gives you almost rewards points? I don't know.
Yeah, that's a really good point. And Matt, last question before we end with a couple announcements, TMA specific, but for you, I'm going to give you a crystal ball. You've got it right now. Here's a crystal ball. What's going to happen from your seat, Matt? Are we going to see more bankruptcy work? Are we going to see a lot more bailout and investment? Are we going to see something else? What do you think happens next for the industry?
All of the above. We're definitely going to see more bankruptcies. We're definitely going to see bailouts, right? There's too much money looking to bail out, and there's too many people who need bailouts for there not to be some marriages, happy or unhappy, coming out of that. We're going to see torrid merger and acquisition activity. People are going to be, acquiring crypto based companies, blockchain companies for a song. We've already seen a little of those fire sale activities happen. And certainly, these losses are going to catalyze regulation in the jurisdictions that like to regulate. The feds, I think, interestingly, have said we want to focus on stablecoin regulation. I think they've taken stablecoin regulation to be, somebody loses money in a volatile Bitcoin, in a volatile cryptocurrency. It's hard for people to get too worked up over that. They sort of feel that was an assumed risk. But the very fact that stablecoin is being used as a cash proxy does create systemic risk, right? People are paying for it on an as if cash basis, and there's more obvious potential for fraud and for losses that could become contagious. I mean, we certainly last year we were starting to see stablecoin come in and to be an instrument of commerce, right? Because as Joe said, transactions in Bitcoin and Ether are primarily speculative, but transactions in stablecoin are primarily not speculative, except to the extent they're the means of making the speculative investments. So people would acquire stablecoin and they would use their stablecoin to buy the non-stable coin. But so Congress weighing in on that is significant. And as I've said to other panels, right, you remember that the financial industry, the established financial industry, wants crypto to be liquidated because to be regulated, because once crypto is regulated, they get to start transacting in it.
Yeah.
Right. And so this is by far the most important thing. The best friend of regulation of crypto is Goldman Sachs and JP Morgan and Citigroup, because they're letting the Sam Bankman-Frieds and the Coinbases of the world make the money that in the mind of those large financial supermarkets, they're supposed to be making, and they can't make that money because of the absence of the regulation that would permit them to. And so that will continue to be the driving force. Now, I would say that this time, in January and February, when Darren and I were on a panel, I kind of said, yeah, I definitely think the financial institutions, they're banging on the doors of the regulators to do this. It's been a bad 6 months. So my guess is that, we're not going to see Jamie Dimon, kind of walk down to his general counsel's office and say, when do I get starting to play in crypto? This thing is going to have to stabilize. So the idea that maybe the stablecoin regulation, a couple of things are going to happen now. I also certainly think that we'll see markets in some places kind of step in with Chinese style bans, right?
Oh,
That's certainly going to be something that folks are going to think about if there have been big losses and big frauds. You could certainly see markets just step in and say, hey, we just don't want this, right? And we think it's a systemic risk and it's tax evasion and so forth. And so that would mostly come out of Asia, but there could certainly be other markets where we could just have bans. And remember, importantly, there's two ways to ban crypto. There's one is to make it illegal, and the other is to deny connectivity to crypto industry to the fiat space. If you can make crypto companies unable to send and receive wire transfers and send and receive ACHs, take credit card payments, you basically ban them. And so we could see that happening at a couple of levels, probably not in the United States or in the EU, but certainly other jurisdictions might start to think about that.
It's really good. This has been, so we're at our time. Thank you, Matt, for that. That's really thoughtful. And on behalf of a couple more admin items, just quickly as we wrap. First and foremost, Darren, Matt, and Joe, thank you so much on behalf of TMA Central Texas, which is Austin and San Antonio. Thank you for your time. This is a commitment and a contract. If any one of you gets in close to us, TMA Central Texas is buying you barbecue. All right.
I'll take it.
And if we can, we're going to do an in-person event and really continue the conversation, because
It's got to be Franklin's though.
Well, there's some up and comers, trust us, but Franklin's is phenomenal. So that's a promise. And then secondly, for those participating, we're going to send a follow-up email with the socials for Matt, Joe, and Darren. If you have business to transact with them or think it might be, you follow them, their published works and those sort of things. We want you to get their information. And also we're going to follow up with admin on the upcoming event at the Austin FC Stadium we're real excited about. So thank you again to Darren, Matt, and Joe, and everybody involved in this. Have a great rest of your week.
Thanks, everybody.